Welcome to Investors Insight, where today's topic is this normal? Question mark. A lot to cover today. Before I talk about an update on volatility that we've seen the past week in the market, Trey, I want you to talk about something that we've really been talking about for a year now, and that's when economic news comes out bad. It was a good thing because it meant the Fed was going to cut rates. But now we're starting to get back to a normal cycle here where good news is actually good news. Talk about that.
Yeah, thanks, Bobby. So our friends at LPL and Bloomberg put together a really interesting chart here. And what it shows is the green line shows when good news is good news, which means the market goes up on good economic news, and bad news is bad news, which means the market goes down on bad news. When it's red on this chart, it means the market is acting counter to what you would think, and that bad economic news is good for the market and good economic news is bad for the market. And as you pointed out, Bobby, we've been talking about this for a while, because when the Fed is driving the market, what happens is that bad news means that the Federal Reserve is likely to cut rates, which the market takes often as positive. And so the market will rally on what most people would consider bad news, like poor jobs numbers, poor inflation numbers, bad growth numbers. But what we've gotten recently is the market is moving with the economic data, and this has some good and bad indications to it. The good indication is it's a healthier market that's driven by the economy. The bad indication is that, like we've been talking about since, I feel like 2022, when as soon as the Fed stopped hiking rates, the market immediately started pricing in the Fed cutting rates. And whenever there was news that the Fed may cut interest rates, the market would rally. But our research shows that when the Fed cuts rates, it actually is bad for the market. Now, that sounds kind of counterintuitive, because lower interest rates are definitely good for investors and investments. But it's not that rates are going down, it's why rates are going down that's the problem. The Fed often cuts rates because they have to, not because they want to. And they typically have to cut rates because the economy is slowing. And they've held rates up high for too long, and that slowed the economy down. And that's kind of what we're seeing right now, is that we got some bad news on the jobs data, and the market sold off, because now the market is saying the Fed may be forced to cut rates as opposed to choosing to cut rates. And so while that is more normal, it is something that kind of brings in a little bit of risk. So while we may be getting back to normal, it's not necessarily always a good thing. But in terms of long-term health of the economy, we think it's a positive.
Yeah, so there's a lot to look there, and we'll kind of keep our viewers open on those topics there. And we've had a lot of questions from clients in the past week regarding the big swings in the market. So I want to share a few charts to show that volatility is actually normal. If you're looking at the historical performance of the markets, the first chart I want to show is one that I actually shared 2 weeks ago that still was relevant, that shows historical pullbacks in the orange columns are actually normal if you're looking at elevated valuations, but that the average performance that you can see in the blue columns can still be positive. This chart actually goes all the way back to 1950, so it is time tested. The second chart shows that the S&P 500 annual price volatility, that shows the market volatility has been fairly muted compared to history, and that we are currently well below the average of annual volatility. And that's why the big market moves seen in the past week might seem abnormal, because of how volatility in the past 2 years or so have been so muted. The third chart shows that even percentages of 1% or more moves is actually below average. You can see that in the previous years, the amount of 1% or more daily moves in the market have historically been a lot higher than they have been in recent years. So while the big moves in the market in the recent days or in the past week and a half seems out of the ordinary, the facts are that they're actually normal. So we'll continue to keep you updated on volatility. But again, we're looking at the economic news coming out to see if we get back to a normal cycle there. We're analyzing the volatility we're seeing in the market. So stay tuned. We hope everyone has a great week. Thanks.